Hi everyone, this is Jason Bierk of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He's former Wall Street bond trader, investment analyst, gold fund manager. He's the founder of Investment Research Dynamics, which has a lot of good articles that I check almost every day. And he has the new popular podcast, Shadow of Truth with Rory Hall. Dave Kranzler, thank you for joining me again.
Thanks for having me, Jason.
Now, Dave, I want to get your opinion on the global economy right now. Do you think it's one big mess?
Well, I guess it depends on how you define mess. I mean, mess would suggest something that can be somewhat easily cleaned up on a relative basis. And where I think things are headed is I am one of these guys in the camp that's we're headed to at least something that was as ugly as the Depression in the 30s. And one of the things that irritates me is that every time you wake up and the stock market's down, the rationalization for it is because of data out of China. Everyone wants to seem to blame it on China.
Lame excuse.
When the fact of the matter is, technically I guess it's a toss-up between whether the U.S. is the world's largest economy or whether China is. But I saw a graph posted that it showed, it was a graph of Chinese exports, and Chinese exports for last month really plunged. And the context of the article where I saw this graph was making it sound like it was a reflection of China's economy, when in fact the ECU and the United States are China's number one and number two export markets. So if China isn't exporting, it's because those two markets aren't buying. And those two markets wouldn't be buying because their economies are in bad shape. So how can you blame a huge decline in China's exports on a bad economy in China and say things are fine in the U.S.? I mean, to me, that's a direct reflection of how poorly the U.S. and the EU economies are operating as well.
Yeah, I agree. It seems like a common excuse there, where in the past, the excuse was the weather. So it's just, the 2-second excuse for the average business person who's putting their money into their 401k or IRA or mutual funds and things like that, just keep putting your money in each month, dollar cost averaging. Don't worry, your account's not going to be halved. Your 401k is not going to turn into your 201k again like it did in 2008. So it seems like, they just keep coming up with excuses to try to prevent that mindset where people start pulling money out. Because we see evidence that, the sovereign wealth funds, these oil guys, these large oil countries like Norway and Saudi Arabia, they've pulled a lot of their money out of equities in the last 12 months.
That's right, and I think there's a lot more of that to go. I think the sovereign wealth funds are one of the question marks in terms of how easy it'll be for the central banks to keep a safety net under these markets, because I saw an article a couple of weeks ago that said, it basically implied that sovereign wealth funds were about ready to pull about $3 trillion out of the global stock market. So,
ouch. Well, that's to prevent their own countries from going bankrupt, right, and their currencies being destroyed and debt defaults, right? So they don't have much of a choice, right? It's either them or the stock market, right? Their own country or the stock market. So you're making a choice here whether to save themselves or the stock market, and that's an easy choice, right? You got to protect your own country first, I guess.
That's right.
Yeah, it's just kind of funny there. We've seen this week, I saw it on Zero Hedge, China's stockpiling copper again, and yet you told me their exports are down. So it's just a head scratcher there, and yet, the oil market and the copper market, the base metals, are having a little bit of a rally. Do you think this is due to fundamentals, or is this just a short covering rally, a temporary rally then, in your opinion?
It's all short covering rally. On down the line, iron ore, oil, copper, obviously U.S. stocks. If anything, if you want to, it probably makes sense for China to stockpile copper because it's a good use of their dollar reserves, right? If they want to convert their dollars into something that has value, one thing they're doing is they're buying a lot of gold. They've been stockpiling a lot of oil. So if they're stockpiling they're stockpiling iron ore, maybe, and if they're stockpiling copper, it makes sense to me. I'd rather take $1 and buy $1's worth of copper than continue to hold that dollar.
Yeah, long term that makes sense, right? Because the copper won't go to zero. The copper, maybe you'll get a little rust on it in the warehouse or something, but at least it won't go to zero. You can clean the rust off the copper, and it can just sit in the warehouse for a decade or 2 or 3 until you need it.
Right. I mean, China thinks in terms of long-term view. It's not, what did you do for me last quarter? What are you going to do for me next quarter? It's a very long-term view. So, I mean, at some point, if economies ever recover, there's going to be a need for copper. So why not buy it now when it's cheap?
Yeah, this oil market rally, too, to talk about oil a little bit more, it seems the oil market rally, we haven't had a lot of larger producers go bankrupt. We've started to see some production in the U.S. come offline. The shale producers who have been given, massive amounts of credit thanks to this Wall Street credit bubble and the Federal Reserve, I think they've announced in the next month or two that Continental Resources and Whiting, who are the 2 largest producers in the Bakken, are turning off production. But, I thought there would be more bankruptcies and more larger producers shutting off the tap, and yet there's not, and yet we have an oil rally. So that's why I'm not fully sold yet that this is a legitimate rally in oil, because we haven't seen that pain where the supply starts to rapidly come offline. It's only a little bit of supply offline right now.
Well, 2 comments there. I mean, first, don't forget that the Dallas Fed went around to the regional banks that are its members and told them not to tank these companies. Don't mark them to market and don't tank them. So the banks are not pulling the plug on these companies, even though they probably could. And that's why you're not seeing bankruptcies. It's the same concept as when the housing bubble burst. Banks were foreclosing on homes, and there got to be so many foreclosed homes on the market that they just stopped putting them on the market. I mean, the banks are still sitting on foreclosed homes from the last go-around. So they're doing the same thing with these shale oil companies as they were doing with the banks. And the reason why they can afford to do that is because of that $2.5 trillion or whatever the number is now of excess reserves that the banks have sitting at the Fed. It gives them liquidity, and so that they won't face a cash crunch by not foreclosing on real estate that doesn't pay or not foreclosing on energy companies that aren't current pay on their loans. So that's what's going on there. And as far as oil goes, everyone's focused on supply, and I guess that's what the propagandists want you to look at. Oh, the supply, how much is being pumped out? How much is in storage? I mean, we get those numbers coming out of our ears. There's 2 sides to every economic equation. One is the supply side and one is the demand side. Well, if the global economies are doing what I think they're doing, it means that demand at best is staying flat on a nominal basis, and I doubt it's staying flat. I think it's declining. I mean, we know diesel consumption is declining because we know that freight traffic is way down. So you're not going to get an oil rally until all of this excess inventory is cleared off. And who knows how you define excess inventory? I mean, you got oil tankers sitting out at sea just holding oil because they don't have anywhere to go with that oil. I mean, let's start with bleeding that off first. Forget about what the Cushing build is or whatever. Who cares? And then the second thing is, how are you going to stimulate demand for oil? I mean, if no one has a job or if people are losing jobs and economies are slowing down, that means demand for energy is going to slow down.
Yeah, unless the oil price goes low enough to where, people have a part-time job living at home with their parents, they can afford, $15, $20, $30 a barrel oil if it stays down there. But it didn't stay down there for very long. Actually, I had dinner recently with a FDIC employee, he's a regulator, and he was telling me he actually listens to our podcast, and I think he listens to yours too, and he buys gold and silver and mining stocks and things like that. And he was actually telling me the FDIC is giving presentations at their meetings that the banks telling all the regulators there that U.S. banks only have 7% exposure to oil and energy loans average in their entire portfolio. I could barely keep a straight face when he told me that. There's no way. I mean, there's so many Midwestern banks that have, way more than 50% exposure.
Oh, yeah.
And then there's the Canadian banks. That's a large chunk. A lot of people aren't talking about this yet, but the Canadian banks have an enormous exposure to the oil sands and also to shale oil loans. And those were the safe Canadian banks, in air quotes. You can't see me do my air quotes, right? That in 2008, right? Those were the better banks, right? So. But, Dave, I want to ask you now about the negative interest rate policy. We've seen it somewhat in Europe. Japan just recently did it. The Federal Reserve, members of the Federal Reserve have put out some trial balloons. Why do you think the Federal Reserve is even talking about negative interest rate policy? Is this just another wealth redistribution scheme?
I think, it's been a pretty well analyzed topic, but in my opinion, it's a way to force savings. For at least the last couple decades, our economy has been predicated on consumption. The consumer has been 70% of economic activity, and if you have negative interest rates, most people are going to be inclined to not pay to keep their money in a bank. And so they're either going to take it out, and if they go to a cashless system, which it looks like is going to happen, and I don't know over what time frame, you can't hoard electronic banking credits. So you either leave them in the bank and pay to leave those credits in the bank, get charged for keeping those credits in the bank, or you spend them. And I think that's what they're trying to do. I think first and foremost, they're trying to stimulate consumption. I think it's also a way to try and stimulate inflation. The entire world is so indebted right now. There's no way that any of this debt ever gets paid back. So why not inflate it away? That's always been the historical solution that central banks have turned to when you can't naturally grow yourself out of a debt problem, then you try to inflate it away. So, and the whole thing is to me, it's just a complete policy disaster. And all they're doing is they're treating bad policies with even worse policies. So, and as to whether or not it's meant to be wealth transferring, or if there's more nefarious motives behind it, I'm sure those are there too. But I think ultimately what they're trying to do is force savings and force people to spend that money.
Yeah, I think that's definitely part of it. I think there's multiple reasons why they're doing it, like you said. But if they, I think there's talk of the academics and the Wall Street Keynesians there, like the chief economists at Wall Street Investment Bank, saying, "Oh, we need to go to 3% negative interest rates. Oh, we need to go to 4%. If we get to those levels, we could see the unintended consequences of bank runs, which is what the legislation has tried to prevent, and also digital money's tried to prevent. Do you think then that bank runs would be unintended consequence then if they went to full cashless or tried it cashless with also negative interest rates?
Well, if you're in a cashless system, you can't really have a bank run because you got to move your money somewhere electronically. So you're either going to move it into treasuries, and that could be another motive behind the negative interest rates, would be to force people to move their money out of a bank account and into treasuries. So it would lend. Everyone knows that the budget deficits that have been reported for the last couple of years have been a total product of phony accounting. Every year the Treasury debt has gone up by a little over $1 trillion for the last couple of years. So the only way that Treasury debt goes up like that is if the government's spending, in a deficit that's equal to the amount by which the debt goes up. So, and the deficit's going to get even worse this year. They just raised the debt ceiling limit, in December to $20 trillion, and we're already over $19 trillion. And that debt ceiling limit was supposed to last until March 2017. It ain't making it to then, sorry. And also, I don't think the rest of the world is exactly chomping at the bit to finance our debt. I know these treasury auctions are going off with insane demand, but I think that's because there's an artificial treasury short in the market from all the hypothecation that's been going on. I don't think China is and Japan and some of the other big Treasury financiers of the last 30 years, I don't think they're opening up their wallets to support U.S. spending. So I think the negative interest rates combined with a cashless system is going to force people to move their money out of banks, and you're going to go either into the stock market or you're going to go into treasuries. I mean, where else are you going to go with it?
That's where they're hoping the regular guy goes who doesn't know anything about gold or doesn't know any Austrian school economics.
Right, I'm talking about the masses. I mean, obviously, guys in our community, we already don't keep our money in the banks anyway, and we've already converted most of our savings into physical gold and silver.
Yeah, this is all shaping up, Dave, unfortunately globally, to one big fustercluck. I did a video last week, and I cussed, and I said the other word, and we got some listeners angry, and they told me to use fustercluck instead.
Oh, there you go.
Yeah, even China is added to the party. China's Keynesian too. They're doing central planning. They're doing financial oppression. They're trying to manipulate the interest rates down. So all the major governments, all the major economies with their governments and central banks are all trying to coordinate interest rates and manipulate. I'm sure they all talk to each other and coordinate policies. Jim Rickards calls it, pass the canteen for the U.S. and Europe and Japan over who gets to devalue at what time and who takes a swig and then passes it on. It's unbelievable that all these games are being played and people are the mainstream financial media is acting like the central banks are independent.
Yeah, which we know they're not.
I completely agree. There's no independence at all. I think they take their orders from either the Bank of International Settlements or they meet up at the Davos crowd or whatever, and they're talking with their other Keynesian economists at their other central banks. My next question for you is about shorting stocks for our investors out there. Now, value investors, a lot of them look for undervalued, contrarian value investment stocks, but there's also a lot of value investors that do look for shorting. You've had some good successes in 2015, starting in 2015 and for part of this year already. How do you find good shorting opportunities? What do you look for in the companies to decide if they're going to be a good short?
Sure. Well, as you know, I rolled out my short sellers journal in early December, and what that is it's a weekly newsletter / report, whatever you want to call it. I refer to them as weekly issues, which will have in the general format is market commentary. If there's some interesting subscriber questions and my answers that might be value added to the subscribers to see the questions and the answers, I'll put those in there. And then I try to have a long-term short sell play and then what I call a quick hit, which would be a short sell play that's meant to be sort of a fill or kill. It's this stock's set up to short. Here's the event that's going to cause it to go down. If that doesn't happen, cover it and move on. So I do that, and you can access it on my website. But in terms of looking for ideas, I mean, in general, the market's overvalued by a significant amount, as you know. And so what I try to look for is ideas that are not just going to go down with the market, but are going to go down a lot more than the market. And part of it is it's sort of, there's not really a science to it. It's more of just being general awareness of what's going on in the market and what sectors are moving. And so, for instance, right now, there's still a lot of retailers that are overvalued relative to the industry as a whole. And we've seen that retail sales, as retailers report, their sales are tending to be disappointing, or if they meet or beat their number, it's on non-GAAP Mickey Mouse. And so a lot of these retailers have been taking like really nice drops after their earnings. So I'll scour around and look for some retail stock ideas for retailers that haven't corrected yet with the entire sector. I think right now, as we were discussing oil, I think make no mistake, this was a massive short squeeze in oil. And I remember about 3 or 4 weeks ago, I saw some data on the short interest in oil futures, and they were at an all-time high. And I said to myself, there's probably going to be a short squeeze coming, and that's what we're seeing right now. We're seeing a big short squeeze in the price of oil. And I'm seeing, you know that it's not, this short squeeze is long in the tooth when all of a sudden you start seeing forecasts coming out for $50 oil by the middle of the summer. So
they're just drawing a trend line, like those commodity analysts on Wall Street used to with gold, right? So when it was at 1900, now it's going to 3,000, and then when it was at 10,000, when it was at 1,000, now it's going to 700.
Right, exactly.
They just draw a line on the chart.
So, and I think the oil short squeeze, if it's not over, it's close to over. And I was looking at, I had a couple oil stocks that I had recommended, I don't know, maybe 6 weeks ago, and much to my surprise, a couple of them are still lower than where I recommended them. One of them's up from where I recommended it by a lot more than I'm happy about, but I know that stock, it's a high beta stock, and if the sector rolls over, that stock's going to be a great short. And I might actually revisit it in my issue coming up this week, where I'll just say, hey, remember this stock, it's run up a lot. Now might be a good time to take a look at shorting it. So the energy sector is a sector where right now I hadn't been looking at it for short ideas, but I'll start looking at it now for short ideas. Home building, same thing. And the home builders have actually been kind of underperforming the market in general. And again, I've had 3 different home builder stocks in my issues, and they're all still below where they were when I recommended them as shorts. I mean, they're close to back to where they were when I recommended them, but they're still below those levels. So, now I think it's a great time to short home builders because I think the housing market's starting to roll over. So it's kind of like it's a hunt and peck process where I just scour all sorts of sources. I look at the market constantly, all day long, every day, and I start making a list and I pick out ideas that I'm going to select for my weekly issues, and that's kind of how I do it. I mean, something like Amazon, to me, it's just obviously overvalued, and all you got to do is dig into the numbers to realize why. So it's a tough one to short because it's one of the nefarious FANG stocks, and it's a hedge fund favorite, and it's easy to get the momentum going higher when people decide to jump in, but by the same token, it's also when it rolls over and drops, I mean, it'll shed 150 points very quickly.
Yeah, your methodology for shorting sounds like top-down macro and then a little bottom-up after you've done the top-down analysis. You go and maybe compare balance sheets after you've done the top-down macro.
That's right, and that's a good point, because what I do is I kind of look at the macro first and figure out what sectors make sense relative to all the other sectors. And then when I look at a company, I absolutely look at the fundamentals. That's, to me, I minimize the amount of charting, although I do include charts and a little very basic technical analysis. But I'm a fundamental analyst, and I believe in fundamental investing for the long term. And by the same token, I believe in fundamental shorting for the long term. And that's one of the things that I hammer my subscribers with over the head every week. Look, if you're going to short this stock, make sure you leave room to double down or add more if it goes against you. And remember, this stock, we're shorting this stock because it's going to be lower than it is now, or a lot lower than it is now 18 months from now. Now, in terms of how it zigs and zags between now and 18 months from now, I have no idea. And with all the intervention that's going on in the market, no one has any idea. It's impossible to predict short-term movements in the market with this intervention. But unless they go into hyper Zimbabwe Weimar mode with the printing press and they drive the stock market up to unimaginable levels, the whole market's going to be lower 18 months from now, and this stock will be lower on a percentage basis than the rest of the market. And so that's what you got to keep in mind. If you get a little bit of a short squeeze rally phase like we're in right now, the tendency is to be afraid and then cover it and take your loss and then wait till it rolls over, and then all of a sudden you're chasing the market lower again, and you cut yourself up that way. So
Yeah, or a lot more flight capital comes back into the U.S. And obviously for the last, 4 or 5 years, we've had a lot of flight capital from emerging markets come into U.S. markets already. So I don't know how much more flight capital is available, especially when we see the data we already talked about, the sovereign wealth funds taking money out of U.S. So, I mean, if there was flight capital coming in, you would think then that would be sovereign wealth fund money coming into the U.S., but that's money leaving. And that's a big chunk of the money. But there was a great podcast a couple of years ago, and Porter Stansberry, I'm not sure if you read his work. I'm not a subscriber to his newsletter, but he did a great podcast on Stansberry Radio before he shut it down a couple of years ago for our listeners, and he talked about how he finds shorts. And, he does do macro ones, but he also looks for companies that have, obsolete technologies like Kodak, where Kodak was, they had the old film business and the digital cameras were destroying their margins and their profits. Or he looks for companies with way too much debt in a bad macro situation. So the company, just has a really bad debt to equity ratio. Their share price is down a lot. They can't sell any more shares because their stock price is already down 80 or 90%. Or they have a bad debt to cash flow ratio like a Lynn Energy or something like that, where, they have a lot of long-term debt on the balance sheet. They can barely make the payments and then the oil price crashes. So and I think there was one more other type of short he looks for. I forget it. This is just off the top of my head. I didn't re-listen to that podcast, but our listeners can find that one, or they can look at Porter's newsletters. But yeah, he's a better short than me. I think he actually found Kodak. That would have been one of the all-time classic ones. There's been some amazing shorting opportunities out there. I think there's going to be a lot of companies, Dave, like Amazon and others. I think the restaurant industry is one of the worst ones. There's so many overvalued ones. Olive Garden has just had an enormous rally. I don't know. I haven't looked at their stock price in the last couple months, but I looked at it a couple months ago, and I had been checking the stock more a couple years ago, and the stock had crashed, and then it had like an enormous rally, because I guess they had like a buy one, get one free to get customers back in. And, they were able to, we have 12% revenue growth, and the stock went up like 40% on like a short squeeze. And I think these restaurant companies, they're going to close restaurants like crazy. We're seeing evidence of this. The consumer just doesn't, in a lot of cases, have discretionary income to go out there and have mediocre food.
That's right. No, I actually had Darden Restaurants was one of my early picks. And it's the stock's above where it was when I picked it, but I still think it's a great short.
Yeah. I don't want to pick on Darden too much, because I think there's a lot of companies in that industry where, the food is mediocre and you're paying too much of a price, and people don't have savings or a full-time job or discretionary income. And they're just, maybe instead of going out to eat there like a couple times a month, people are going to go out to eat there at most once. So that's business at least cut in half. That's just, me out there seeing restaurants and talking with like servers and restaurant managers and things like that. Well, I want to transition now to gold stocks, because our listeners love to talk about gold. Do you think the gold bull market has restarted?
Boy, that's the $64,000 question, isn't it? I think there's a good chance that it has. I think we can probably say fairly definitively that the bottom's in. So whether or not we're getting ready to make the I think we're in the early stages of the next bull move for sure. And how long it takes to play out is anyone's guess, because make no mistake, the central banks and the bullion banks and the BIS and all of the usual criminals are going to fight this as hard as they can. So but yeah, no, I think it's safe to go back into the water in these mining stocks. And I mean, when you look at them, most of these juniors, not most of them, but a lot of them have doubled since mid-January. And people might look at that and say, oh, well, I missed it, which they haven't, because you got to remember these things are down 90% from their top in 2011. So, most of these stocks, just a mere double doesn't even begin to recoup 10% of what they lost over the last 5 years. So it's one of these things where I think you just got to look at good quality. And I prefer the junior mining stock sector, although I don't throw out the senior producers or the larger caps. In fact, on my debut Mining Stock Journal issue that was released last Friday, I had a larger cap producer that is, I mean, you could call it probably an emerging senior producer. So, but I do think that if you have a portfolio, and not too highly diversified, but a concentrated portfolio of well-picked out junior mining stocks, I think you're setting yourself up for the potential to make lifestyle-changing money.
That's pretty amazing. Now, I know, in 2011 when we had the manipulation knock the paper price of gold and silver back down, and, people like me, we bought the dips. We thought, there's no way they could keep knocking the price back down. But it really just seems the miners were, a lot of them, the ones who weren't in the emerging market countries, who didn't have the cheap currencies, they were on their last leg. So we're going to have supply problems if the bull market didn't restart, when it did again.
Right, exactly. So, and a lot of these juniors are sitting on proved resources, and the ones who have had cash and have had the staying power to keep their businesses going and do, continue advancing their deposits, a lot of these companies are going to be set up for takeovers because they're sitting there with proved resources in the ground, and they just don't have their whole strategy was to develop a deposit to the point where it's ready for a mine to be put in place. And there's a bunch of these companies out there that are good to go as soon as the larger mining companies have the capital to make to start putting in mines or and make it happen.
Well, a lot of the larger miners, Dave, they did really bad acquisitions and took on too much debt and overpaid at the top. We're seeing the mid-tier guys who were more prudent. We're seeing the mid-tiers do the acquisitions now. Like Tahoe Resources just bought Lakeshore Gold, and we saw Silver Standard make a bid recently for Claude Resources. And I think there's not the Karma Gold Mine, which is run by True Gold, which is a really high-grade, low-cost operation. That just got bought by, I think, Endeavor Mining, which is an African gold producer. They're going to be a mid-tier. So we're starting to see some deal flow. I think PDAC, I'm reading I didn't go to PDAC in Toronto, but I'm reading a few articles, and it looks like there's more deals going down there. We're starting to see private placements again, a lot more of them at better terms. So it's starting to look like, at least there's money going back into the sector, which means the sentiment is changing. People think that if the bottom isn't already in, then it's very, very close.
Well, the real smart money has been putting money into this sector for well over the last year. So I think the next to really smart money is now starting to come in. And then at some point, the institutions will come in, and then the retailers will come in, the retail guys.
Oh, yeah. I was buying Sandstorm Gold when it was around $2. I was adding more to my position in Sandstorm Gold when it was around $2 a share because they had cash flow still. So I was like, well, this is a cash flow company right now. They're generating free cash flow, and they're doing deals. So the market, isn't giving it the same valuation as the other royalty and streaming companies. But I thought, worst case scenario, maybe they get bought out by a larger one, because at least they have cash flow, so they didn't have to sell as many shares, although they were, doing deals with the shares.
Sure.
I want to ask you about the GLD right now. It seems there's a problem with the GLD being able to source metal. Is that correct?
I think that referenced BlackRock's gold ETF.
Yeah.
I don't know what they call it. The ticker's IAU.
Oh, it's not the GLD. It's the other one.
Yeah,
okay.
And I think Zero Hedge sort of made the leap of faith that the reason why they weren't selling more shares is they were having trouble finding gold. And that's something that's impossible to prove. I mean, to be honest with you, none of these ETFs, there's no way to know whether or not these ETFs really have the gold in them that they say they're supposed to have, because there's no legalized mechanism of accountability for these things. So GLD, for instance, can report that it's got 783 tons of gold in there. Well, their prospectus has evolved to the point where now that can mean gold receivables. So that's not hard gold in the trust. That's not bars sitting in there that belong to the shareholders. And there's no accountability mechanisms to verify that they do have all that gold in there. So, I mean, it reminds me of I think it was 2010 or something, when CNBC made a big deal with Bob Pisani going into the GLD vault to show everyone that the gold's really there. And he walks into a room with all these pallets of gold, and the person instructs him over to a certain pallet and said, yeah, that's GLD's gold. And he picks up the bar and shows it to the camera, and they caught the serial number on the bar. It wasn't GLD's gold.
Yeah, I remember Ned Naylor Leland talking about that.
Right.
That was one of his bars in his fund, right?
Vividly remember when it happened. So, I mean, that proves the point right there. There's no accountability. There's no credibility. I would not own GLD because I think all you're doing is buying a piece of paper. And even if you do buy GLD, and even if it was completely backed by gold, you're still not invested in gold because you can't take delivery of those bars. And I know for a fact that there have been some large, sophisticated investors who have tried, because technically, according to the prospectus, if you own 100,000 shares of GLD, you're supposed to be able to turn that into the trustee and remove $100,000 worth of gold bars from the trust. That's in the prospectus. Now, they do have a backdoor loophole in there where the trustee can deny that for any number of reasons. But I know that there have been a few well-heeled institutional investors who have tried to take delivery from GLD, and they've denied them.
Yeah, I agree. I've heard the same thing. I know Grant Williams, when he was managing the Volpez Gold Fund, he tried to do that and was denied. And I've heard other stories of other big shot Wall Street guys trying to do that as well,
right.
And they were told to go take a hike too.
So that kind of tells you right there the gold's not in there. But if you invest in these trusts, it's like, I don't care if IAU can't source gold. I wouldn't touch that thing, and I wouldn't recommend it to anyone. You're not buying gold when you buy those things. The only way you own gold is if you buy physical gold and silver, and you can hold it in your hands. Anything else, there's counterparty risk. Even any custodian, there's still counterparty risk. And it doesn't matter who the custodian is.
Yeah. I mean, I think there was some gold in GLD, but yeah, the people couldn't take delivery. I had heard stories from some of my Wall Street contacts that when the premiums in India were actually high in physical gold last year and the year before, last couple of years, that Wall Street, the people who are the custodians were raiding and pillaging the physical gold out of GLD and selling it onto the black market for a huge premium. So. So the goal's not there for the average guy, to comply with, but yeah, for the people, the rules changers, the people, the economic elites who have the lawyers to change the rules. Yeah, the gold's there for them to do whatever they want with, and scalp and make extra profits and cheat and things like that.
Right, exactly.
Now, the RMB is going to go into the SDR, I guess, later this year. Do you think that's going to have a big impact maybe on the global economy and the gold price?
I mean, I'm not really sure why it would. I think it's more just a ceremonial event more than anything. What I find interesting, and again, it may be just because I haven't been paying close attention to it, but for quite some time, Jim Rickards was out there promoting this idea that the SDR was going to be the next reserve currency. And I know why he was doing that, but I don't think, unless, again, I don't really pay that much attention to what he puts out there, but I don't think he's been on that stump as aggressively as he used to be. And I don't think the SDR is going to be the next reserve currency, and I don't think that's why China insisted on being part of that basket. So, honestly, I could be completely missing the boat here, but I'm not really sure why it's a big deal that the yuan is now going to become part of that IMF SDR basket.
I think China just told the U.S., you know what, we have you over a barrel. We're dumping your treasuries. Russia's dumping your treasuries. We're buying gold. We can't put all of our paper reserves into gold, and you're going to do whatever we tell you to do.
Yeah, that could be also. I don't really know. I just think there's better things to spend time analyzing than on what's going on with the IMF SDR, because it's just another fiat currency.
Okay, well, my final question for you then is, why do you think then that Canada and Venezuela are dumping gold in what looks like the bottom right here?
Maybe Gordon Brown has the answer to that.
Well, I would say Venezuela's situation is probably a little bit different than Canada's. Venezuela's broke, right? And they have to sell whatever, they have to sell everything just to live another day, right? The government can survive another day.
I think that Venezuela had its gold extorted from it. I mean, literally, it was 10 years ago or something that Hugo Chavez went to great stakes, great pains to get that gold repatriated. It might have been less than 10 years ago. I don't remember exactly when.
It was like 2008 or 2000.
Yeah, whatever
it was a little bit after 2008.
Whatever it was. And I think what happened was that Venezuela started running into cash flow problems. And this is right out of Diary of an Economic Hitman. The banks all of a sudden come in and lend Venezuela money to give them liquidity. And Venezuela, because of what's happened to the price of oil, can't make payments on that debt. So the banks like Goldman Sachs have them over a barrelhead. And recall, Goldman Sachs was trying to dislodge that gold from Venezuela about 18 months ago. I don't know if you remember that, but they proposed a lease deal with Venezuela and it's because these bullion banks need this gold to make deliveries under their contractual, their futures and LBMA forward obligations. So I think Venezuela's gold was extorted from it. In terms of Canada, it's probably the same situation. I mean, their treasury is probably getting decimated from what's happened in not just oil, but all of the base materials. I mean, that's what Canada is. It's oil and base materials based economy. So I think Canada was probably forced to sell its gold in order to raise liquidity, for its treasury purposes.
Yeah, I think Venezuela's got an enormous amount of problems. I've been because one of my friends, actually he made a good amount of money speculating. He actually figured because Venezuela's so broke that they were going to come to an agreement with that Canadian Gold Junior that has the big gold deposit, and actually they agreed to a 50-50 joint venture recently to start mining soon because they need the cash flow. So, instead of confiscating the whole asset, the government there in Venezuela, who's, hardcore Marxist there, instead of confiscating 100% of the asset again, they finally agreed to some type of, joint venture deal where the Canadian company can develop the asset and they can get some cash flow. So it's funny there with all the crazy stuff going on. There's like milk shortages and shortages at supermarkets and hyperinflation and, 50% currency devaluations overnight. It's a disaster of a country. It's like turning into Zimbabwe.
Yeah, exactly.
Well, Dave, my final question for you, I like asking this to a lot of our recent guests because our listeners out there, they're tired of all the rules changes. It's confusing to them. They're frustrated with, should I have cash? Should I have gold? Should I have money out of the banking system? Things like that. Where should I be investing? Do you think 10 years from now that we're going to be looking back doing a podcast or maybe, we'll have our own radio show or a TV show by then. Do you think that we're going to be looking back 10 years from now and saying, how did they keep this the same global economic system going? How did the banks, how do people still trust the banks? How are the asset markets still up and things like that?
Jason, I have no idea. I don't look 10 years out because I think with what's going on, especially in this country politically, I'm not really sure what things are going to look like 10 years from now. I mean, what I think is happening is that we have something coming at us in the system that's going to make 2008 look like a day at the beach. And it's going to blow our system apart. And I don't know what it's going to look like when the pieces settle and someone tries to put them back together. So in terms of what it's going to be like 10 years from now, I can't imagine.
Yeah, my crystal ball's broken too, but I live right outside of Washington, D.C., and I know some of the lobbyists here, and I speak to them, and I speak to some of the government employees and regulators. There's going to be a lot of intentional inflation and a lot of taxes. So, the Keynesians, the people on the mainstream financial media, they're going to say, deflation. But, your property tax bill is going to go up. Your Obamacare health tax bill is going to go up if you live in the U.S. They're going to layer on all kinds of new taxes. It's just going to piss people off, and it's going to take away their standard of living even more. So that's what I see going forward. And, there's going to be a lot of rules changes with maybe they're going to force, like you said earlier in the interview, they're going to force people's cash into treasuries, or they're going to go after maybe 1% of your 401k or IRA. It's going to go into treasuries for national security or something. In the next, 10 years, I could see them implementing a policy like that as well.
But see, you're talking to people who are under the assumption that the system's going to stay intact for the next 10 years and the next 5 years. And I'm saying I don't think that's going to be the case. Because I think 2 years from now, we could be looking at a situation where 50% of the country is unemployed. And I think it's going to get very, very difficult around here or in this country from every perspective, political perspective, economic perspective, et cetera. I mean, we're basically 95% of the way to a totalitarian government system right now.
It's a good point. Yeah, when the two most popular candidates are Bernie Sanders and Donald Trump, who are, to one degree or another, totalitarian, or worse in some cases.
Obama's totalitarian. If he needs to get something done, he just signs an executive order.
Well, at least the Republican Congress, though, is kind of blocking some of the stuff because Obama wanted to put even worse stuff in. So at least there's some gridlock there. I think the best thing that happens, is when the presidency and Congress aren't on both sides of the aisle, because then at least they can stop each other from completely ruining things even worse. Welcome to dystopia, man. This is
exactly. There you go. That's why
I told myself I would. What did you say?
That's why your show is so timely. Your show with Eric Dubin of the News Doctors.
Yeah, it's apropos, and I mean, I try to be sarcastic and satirical. I almost feel like it's like The Onion here, except a lot of the stories report are true.
Right, exactly. That's exactly right.
Whereas The Onion, makes stuff up and does the exact opposite. It's like backward. It's like an Orwellian backwards saying where up is down and left is right and inside is out, and the stuff is actually happening, and most people have no freaking clue that it's actually happening.
Mind-blowing, isn't it?
Yep. Or around here, for people in my age demographic, people with a couple college degrees, it's hip to support Bernie Sanders, and I have friends who are making good money at jobs, who have found good jobs, and they're in the middle class and they support Bernie Sanders, and I tell them, you vote for Bernie Sanders and he wins, your tax bill is going up 30%, and they're like, no, he wouldn't do that. No, all the information is out there, and people just don't want to listen. They don't want reality. They don't want the Matrix analogy. They don't want the red pill. This is all just one big clusterfuck. Okay, Dave. Well, how do our listeners find your podcast and read your articles and try your newsletters and reports?
My blog is investmentresearchdynamics.com, and all of the links to my Short Sellers Journal and Mining Stock Journal are right on the front of my blog, and they're both a monthly subscription basis, so you don't have to pre-commit to it for any longer than a month, and you can basically cancel it, after a month if you're not getting anything out of it. So, and I don't have the infrastructure set up yet, but for people who subscribe to one of the journals, they'll be able to subscribe to the other journal for half price.
Very nice. Well, I just want to thank you for your time today. I enjoyed the discussion, and we'll try to have you back on every couple of months because I haven't stuck to that timeline regimen recently.
No, I understand, and I'm glad to hear that. It sounds like things are going better for you from a personal standpoint. So, but certainly, I'd love to come back on, and I appreciate the opportunity to chat with you.